In 2019, a single company convinced investors it was worth $47 billion. 6 weeks later, that number collapsed so fast it shocked Wall Street, not because the market crashed, not because offices disappeared, but because one truth finally became impossible to ignore. Behind the glass buildings, the inspirational slogans, and the promise of changing how the world works, this company was bleeding money at a scale most investors didn't fully understand. Billions were being spent, losses were accelerating, and yet more capital kept flowing in. This is a story of how belief replaced fundamentals, how valuation replaced discipline, and how one of Silicon Valley's most celebrated companies exposed a dangerous flaw in modern investing. WeWork wasn't supposed to fail. It positioned itself as a technology company, not a real estate business. That distinction mattered, because tech companies are valued on growth, not profit. At its peak, WeWork operated in hundreds of locations across major U.S. cities: New York, San Francisco, Los Angeles. Investors were told this wasn't about renting desks. It was about data, community, and the future work. Money poured in from some of the most powerful institutions in the world: private equity, venture capital, global investment firms. Each new funding round pushed the valuation higher, and with every increase, scrutiny quietly decreased. Because when momentum is strong, questions feel unnecessary. Underneath the branding, WeWork's business model was dangerously simple. The company signed long-term leases, often lasting 10 to 15 years. Then it rented those offices out on short-term agreements. In good economic conditions, this looks efficient. In bad conditions, it becomes lethal. If tenants leave, the lease payments don't disappear. The risk stays locked in. From a capital allocation perspective, this created massive exposure. Fixed costs were high. Flexibility was low. Cash burn increased every quarter. And yet, losses were reframed as investment in growth. In 1 year alone, WeWork lost more than $1.6 billion. For most companies, that would trigger alarms. For WeWork, it triggered another funding round. As the numbers worsened, governance weakened. The CEO, Adam Neumann, held extraordinary control over the company. Special voting rights ensured his decisions were rarely challenged. He borrowed money from WeWork. He leased buildings he personally owned back to the company. He made strategic decisions that blurred personal interest and corporate responsibility. From a financial standpoint, this was alarming, but the valuation kept rising. Why? Because investors weren't just backing a business. They were backing a story. And stories are powerful enough to override spreadsheets. At this stage, logic took a backseat to psychology. Large investors feared missing out. Smaller investors followed their lead. And the biggest backer of all, SoftBank, doubled down. Instead of reassessing risk, capital allocation increased. Not because fundamentals improved, but because pulling out felt worse than pushing forward. This is known as escalation of commitment. The more money invested, the harder it becomes to admit a mistake. And so the valuation climbed, even as the foundation weakened. Everything changed with the IPO filing. For the first time, WeWork's financials were exposed to public markets, and Wall Street reacted immediately. The losses were impossible to ignore. The governance structure raised red flags. The business model no longer matched the valuation. Confidence evaporated. Within weeks, the IPO was pulled. Leadership collapsed. The $47 billion valuation disintegrated. What private investors tolerated, public markets rejected instantly. WeWork survived, but in name only. Thousands of employees lost their jobs. Assets were sold. The company was restructured under emergency financing. Investors absorbed billions in losses. What was once a symbol of innovation became a warning. Not about offices, not about startups, but about what happens when capital chases belief instead of discipline. WeWork didn't fail because people stopped working in offices. It failed because valuation outpaced reality. When investors stop asking how money is made and start asking how fast a story spreads, risk compounds quietly. And by the time it becomes visible, the damage is already done. The most dangerous companies don't look risky. They look exciting. They look inevitable. They look unstoppable. And somewhere in the market today, another company is being valued on belief instead of fundamentals. The question is simple. Will investors recognize in time, or will history repeat itself? Every major company has a story they don't want told. Subscribe if you want to understand what really happens behind the scenes.